Well, thank you and welcome to the fourth installment of our Healthcare Real Estate 101. As we think about some of the other broader transaction dynamics and things that are important to consider, as you contemplate a transaction, right? You first off, just thinking about, right, the folks that really matter in the room, right? The partner physicians who are own and work at the practice in a day-to-day. Right. Oftentimes we'll see, various structures in place. So for example, you have a one-to-one. So if you're a partner in the practice, you have to be a partner in the real estate as well. This makes things fairly clean, but oftentimes that isn't the case. Oftentimes you may have a portion of the physician practice that made the initial investment, developed the real estate, and over time, perhaps some of the younger physicians or mid-career physicians haven't had the opportunity to buy in. Right. So that can create some interesting dynamics as you try to work through, how do you get to a sale transaction with a sale leaseback, right? Given you will have some folks that may not be getting the return on their dollars for the long-term lease that they're about to incur, especially if you have perhaps some physicians who are more advanced in their career looking to cash out. And, to do that, they need a long-term lease to do a sale leaseback. But meanwhile, they might be retiring in a couple of years, and now you have this other group of physicians, of younger partners, who now has to incur that lease payment in the long term and isn't getting that upfront consideration from the sale leaseback transaction. Separately, there's also thinking about ownership transitions, so buy-ins and buyouts, new partners who are coming in who might be indebted to the property company. And frankly, the practice as well, to help fund their buy-in. And then also outstanding liabilities, how many physicians have since retired? And so how many buyouts do you have on the balance sheets? How much debt do you have that is owed to physicians that have retired? And all this really can be kind of phrased as, how do you look at the investment horizon and what is the value in today's dollars to each one of these contingents? Oftentimes for physicians more advanced, it's just a return of capital, right? For younger physicians, oftentimes that's really looking at what is this long-term stream of rental income I would have gotten otherwise versus what am I getting out of the deal today?
I think that's a great lead in. You can never time the market, but the way to look at it is if your building's worth $500,000 for each investor and you're getting a $15,000-$20,000 return a year, what could you do with that $500,000 if you invested it right up front? Number one. But I think more importantly, we all went into real estate to pay ourselves, right? Because we've heard that that's the best thing to do. And that works really well. And depending on how you structured your original deal, the buyout, that can really factor into the buy-ins and buyouts. For us, we were able to take advantage of a very nice marketplace where we were able to finance a majority of our building, the first building. And so our physicians put up a very relatively small figure to control a 45,000 square foot building and 4.5 acres of land. And so that was number one. That was a big win. And we financed it at a fairly low rate at the time. The second thing that happened with us is that we were able to subdivide the land, which was prime real estate. And we used the subdivision of the land, the value of that, to actually finance the second building. A 45,000 square foot brand new state-of-the-art building with an ASC in it. And we had our future co-tenants, one took the first floor completely, paid for their build out, and the second one paid for half of it, our hospital partner in the ASC. But the amazing thing about our second building is that we put up no capital. We built a very expensive state-of-the-art 45,000 square foot building and put $0 into it. We basically used the land as the down payment. So now all of a sudden we control all this property with very little money out of pocket. And then we get an unsolicited offer for both properties and we just couldn't believe it. So now we have a problem. So now, according to our operating agreement in the LLC, we have to basically appraise our buildings every 3 years, or get at least a bench top. And we also, certainly the LLC members want to be bought out at fair market value. Now, what do? So you have this pretty exceptional, buyout that you have to figure out what to do. And then the new guys want to get in, and they want to get in at a good value, but you can't give it to them. And maybe you could give them a half a share or a quarter share. There's other ways you could structure that, but that's not as enticing to them long term. So we really created this, as I said at the beginning of this podcast, a good and a bad problem. We had significant valuation, and really what we saw as the only way to exit is to exit with the best bidder of our property. And we had 30 some offers on our properties, and that's what happened. But subsequently, our practice decided to do the same thing again. So over the last year and a half, basically our practice had a lot of people retire, a lot of new influx of younger physicians, as Witt's practice has. And they decided to do the exact same thing again. They bought another building, and now they've occupied that, and they have a tenant that's an imaging partner in the building. It is basically the redo of what we did years ago. And interestingly, those same younger people who were upset at our transaction because we were renewing this lease, who said, well, we could have structured the deal to help, people come in and come out. They found no other ways to structure the deal. They basically created the same deal that we had in our original buildings. And so they found that, this is a real issue, that you have to, money just doesn't come out of free air. You have to figure out how to finance things correctly. And so, and to buy, sell these things correctly. So that's how they've structured the new deal. So I think there is some limitations in the way, how creative you can get, but certainly I'll leave that to Witt and our BGL partners.
Yeah, I think Dr. Fabrizio is correct. I mean, timing is everything in these transactions. I mean, if the timing is not right, the transaction is not going to be the best one. And we, albeit differently, experienced it differently because our timing had to do with partners retiring and the sheer number of partners left. And so for us, when you have an equity event and you're splitting it by fewer partners, that's more per partner. And so that's, in my opinion, always a good timing of an event. So, and you take that real estate off the books. So now the new partners that will buy in won't be buying into the real estate. Yes, you have a rent piece, you have an expense on your P&L. That expense is going to be there either way. But now you have a new partner that's not going to have to come up with paying into a partnership that they're not going to get a dividend off of, which is the real estate piece. And so, I mean, to me, timing is everything, but I think you got to look at your partnership as a whole. We were fortunate because we've always had this sort of mantra that said we wanted our partners to be equal partners in the operating company and the real estate. So we never compromised our real estate by having a bunch of partners that were still partners, but not partners in the operating company. And so for us, having that kind of mantra, we wanted equal partnership in both operating company and real estate, actually helped us in the end when it came time to look at selling of our real estate in a sale-leaseback transaction. And so timing is everything. And I think you just, every situation is different, and you just got to look at your situation and look at all the opportunities and get someone you trust like BGL to help you walk through this situation, because they do have access to not one or two buyers, to 30 buyers, as Dr. Fabrizio said. And so you can get your best opportunity for a long-term sale-leaseback transaction or whatever transaction you're looking for.
They're great partners. I agree with. That's it would be, I think, foolish to try to do this on your own. You really need the sophistication of a BGL. And well, I'd like to thank you guys personally for me, involving me in this podcast. I'm happy to answer any questions for any of the listeners in the future. I have to run actually to another webinar, believe it or not, but unrelated to real estate. But thank you so much.
Thank you. We appreciate your time. Just to build on what what was said here by Dr. Fabrizio and Witt, especially related to, how, there really isn't a perfect time to do a deal for everybody, right? You can't always please everybody, especially, given they had the foresight to, kind of structure their ownership to have kind of that one-to-one ownership in the operating company and the property company. Not everybody's going through that exercise for one reason or another, but there are definitely mechanisms that can be utilized to get that done. For example, there's what's called a profits interest, which allows for some consideration to be paid for non-partners in the real estate, but folks who are partners in the clinical business or the operating company, to make sure that they're getting due consideration from a transaction in exchange for their willingness to sign a long-term lease to ultimately facilitate or enable a sale-leaseback transaction. And with that, I think, that concludes our fourth clip. Obviously, there's a lot of complex subject matter here, and every situation, as we've noted, is a little bit different. So please feel free to reach out to Mike Janus or myself if there are any questions related to, anything regarding your particular situation around your practice and or real estate. Thank you for your time.